Welcome back, everybody. Thanks for joining us again today. Once again, my name is Ashley. I am the moderator. Today we are going to look at part 2 of our story of Nexus. The webinar today will last 90 minutes. Once again, we've got some poll questions, and toward the end, I'll make sure everybody gets their CPE certificate. Also, if you have any questions during the presentation, feel free to chat those to us, and we'll see what we can do about getting you an answer. Again, today our presenter is Andy Johnson. So let's be brief and just kick it off with, over to you, Andy.
Okay, wow, that was quick. Okay, let's move along here. I wanted to be brief because we have a lot to cover today. So thank you everybody for being here. I see that most everybody that was here in our last class is here today. We're getting along really quickly here, so they're probably thinking they got a few minutes to go through the housekeeping items. But like I said, we've got a lot of stuff to cover today. We're going to leave behind in a moment the history of Nexus and move to some of the more practical, what is it like now? I thought that the history was important so that you can have perspective on what's going on now. So with that, I will say goodbye to you video-wise. Goodbye video-wise. And let's move on with our presentation. I want to start today's discussion with another case study. And I know that we haven't totally wrapped up the mattress company, but we will. There's still one more piece of information that we need to know. Or one more, what's the law about making deliveries in your own trucks. But I want to introduce a different company. This one is a client of ours, so I've sanitized the facts a little bit, changed the nature of the business to keep confidentiality. That's a really big deal. So it's not really a valve company, but it's a manufacturer of tangible property that it's about a $20 million company, a long-time client of a CPA firm that we do a lot of work with. And they manufacture specialized valves, we'll say. They were an excellent client of this CPA firm. CPA firm has issued clean audit opinions over the years. They've got, they're not a publicly held company, but they've got bank loans, etc. So covenants that they need audit verification. As far as their Nexus footprint is concerned, they have no property or employees in other states. They all the valves that they sell are usually sold to contractors who then put them or incorporate them into real property owned by the government, military bases. And so that's who they sell to. And so a lot of people would think, well, that's the federal government, so I don't have to worry about sales tax. It all should be exempt. And that's an okay thinking for the most part. Every state is a little different. The way they got business was by using independent sales reps. So by now, hopefully, in all the things that we did in our last class, you know that independent sales reps are a Nexus creating activity. And since you know that, that puts you probably in the 1% of all even CPAs. I don't know what percentage it puts you in the at-large world, probably 0.001%, but even of CPAs, as I talk to various CPAs around the country, this is one of the things that's kind of shocking to them, the independent sales reps. Okay, so that's how they conducted business. So naturally, they didn't think that they had any sales tax problems, and neither did their CPA firm. Well, the time came, it was a father and son that owned the business, and father is getting on in years. Son wanted to do something different, so they decided, let's sell our company. And like I said, they really had no other Nexus creating activity. So as they went to sell their business, they found a buyer, thankfully, and a buyer very interested, conducted all their due diligence, and really everything came back clean in the due diligence phase, except for one area, and that was um, state tax exposure. Some questions about state income tax and some real concerns about sales tax. And so selling the company for 20 million, they come back and want a $10 million cut in price. All right, what does that do to the company that's selling, and what does it mean to the CPA who has issued clean audit opinions all of this time? Well, it's an obvious deal killer. Probably the $10 million purchase price doesn't even cover the debt that they have on the company. So it has other very, very serious ramifications, of course, for the CPA who has issued all those clean opinions over the years. Because if it's true that they have $10 million of exposure, then are they even solvent? And what does this mean? So it's time to panic when this happens. So something for us to think about and for us to address and figure out is does this company, the valve company, have income tax issues? Do they have Nexus? And if so, how do they apportion their income to those various states? Do they have sales tax problems? Do they have Nexus? And if they have Nexus, can't they just get a resale certificate from those contractors or a federal government exemption certificate? So is the buyer off base? Can we just tell the buyer, you guys are totally off. We've never been audited before. That's because we don't have this exposure. Should we just tell the buyer to back off and don't worry about this? So you should know by now, of course, that independent sales reps do create Nexus. And remember, last time we met, we talked about some of the protection that is offered in the U.S. Constitution. We talked about the protection from the Due Process Clause, the Commerce Clause. We noted that the Due Process Clause isn't that great of a protection, but the Commerce Clause seems to be, for 100 plus years, seem to be very, very solid protection. We noted that the pendulum, the momentum, whatever you want to call it, seemed to swing back and forth with the various decisions at the Supreme Court. And I would just point out, the reason why we go through all of those decisions is it's not that those older decisions are obsolete or overruled. They're not. They're still in force. And that's really the only guidance that we have. There's only that one federal law that we talked about, Public Law 6272. That's the only federal law that there is about Nexus, income tax or sales tax. So that's why we spend so much time on those cases, is because you got to understand what is out there, what guidance do we really have. We talked about Public Law 6272, that it's just a protection against net income tax Nexus, and it only applies if all you sell is tangible personal property. If you sell services, then it doesn't give you any protection at all. And of course, it's no protection against sales tax Nexus. We noted finally that it still takes physical presence, or it has taken physical presence to create Nexus. So Ashley, how about a quick poll question?
Okay. And launch the poll. Hopefully we'll have a quick crowd today. Okay, that's just about everyone, so I'm going to go ahead and post those results.
Okay, great. So Nexus comes up for most people, at least occasionally with your clients. Very good. All right, the final case I would like to cover today, very important case. came out in 1992, so 21 years ago, going on 22 years. Still very important in the sales tax world and income tax world. So let me just cover it, because first of all, it went to the Supreme Court of North Dakota, and then it went to the U.S. Supreme Court. All right, so let's just cover the facts. Everybody has heard of Quill. All right, it was a company, still a company, selling office supplies through catalogs. Back in 1992, of course, there was no internet, and these guys were headquartered in Illinois. They had no offices, no warehouses, no employees, no independent sales reps. So everything's cool, just like Bellis has. And except North Dakota said, well, if the test is physical presence, there's one distinguishing factor between you, Quill, and Bellis Hess. We found 3 software diskettes owned by Quill in North Dakota, in the possession of North Dakota customers, some sort of office supply spreadsheet type software. And okay, so we got you on the physical presence. Well, Quill said, North Dakota, you got no power to force us to collect your use tax. That's your tax. You can tax people in North Dakota. We are protected by the Due Process Clause, by the Commerce Clause, and most especially, our exact fact pattern has already been examined by the U.S. Supreme Court, and we are covered. We are a mail order operation. So why are you even troubling us? We have, our case has been to court before through Bellis Hess. North Dakota said, well, wait a minute, that was way back in 1967, 25 years ago. And since in that intervening time, there has been tremendous social, economic, commercial, and legal innovations. Okay, what were the legal innovations of the past 25 years? Those cases that we cited, Complete Auto Transit, probably the biggest one, Tyler Pipe, that all came down since 1967, which said maybe you don't need physical presence to have Nexus. At least that's what North Dakota said. And if physical presence is still so important, well, we've got these software diskettes. But we just think, and the state Supreme Court agreed with the North Dakota Department of Revenue, by the way. So this is the state Supreme Court ruling. The state Supreme Court looked at Bellis Hess, and you have to if you're going to rule in favor of North Dakota here. And so what they said is, we just think that Bellis Hess should be overturned. There's been a whole bunch of changes. It's not nearly as difficult to comply with the law now, with all those taxing jurisdictions now, as it was way back in 1967. Plus, there's a lot of mail order businesses now. Everybody is selling over by catalog. Okay, we're thinking 1992. Internet wasn't even thought of back then, hardly. So, we're missing out on a lot of revenue. Okay, does that argument sound familiar to you? We're missing out on tax revenue, therefore we need to impose new laws on you people. And here we are in 1992, and there's been significant advances in computer technology, and it's not nearly as difficult to comply with the sales tax laws as it was in 67. And physical presence isn't nearly as important, we don't think, as it may have been in the past. The fact is that North Dakota is providing a lot of benefit to Quill. The very economic climate necessary to conducting your business in North Dakota is because of our government. Plus, you guys are sending all these brochures and catalogs into our state, and then we have to dispose of them. So you're using up our landfills. And your mere economic presence, okay, so that's an argument that you're going to see a little bit more of. Your mere economic presence is enough, sufficient nexus for you to have to collect our use tax. Well, thankfully for all businesses, Quill did not, that was the ruling they got, very, very bad, a lot of money. They thankfully appealed it to the U.S. Supreme Court, and thankfully the U.S. Supreme Court took the case. So what did the U.S. Supreme Court say? Well, they overruled the North Dakota Supreme Court. And they said North Dakota has no authority to force Quill to collect North Dakota's use tax. Also, they made a really important distinction between what constitutes nexus for due process and what constitutes nexus for Commerce Clause purposes. That's very important because the Congress does not have the right to ignore your due process rights. Okay, that's not something that's reserved to the Congress. That's one of your inherent rights of due process. But Congress does have the reserved power to regulate interstate commerce. So the fact that the U.S. Supreme Court made a big distinction here, because until this point, it's been a really muddled issue. Is this a due process protection we're getting, or is it a Commerce Clause protection? Now the Supreme Court is saying, you know what? There is a difference. You can satisfy the requirements of the due process. A tax can satisfy those requirements and yet not satisfy the requirements under Commerce Clause, okay? But it's really easy to satisfy the due process clause because it only requires a minimum connection between the state, not a substantial connection. A minimum connection is all that the due process, because remember it says the government does not have the right to deprive you of your life or property without due process of law. Okay, and we said that's not a really strong argument, but people have made it, and the Supreme Court says, yeah, I mean, before they force you to pay their tax, you've got to have some minimal connection. All right, so basically, Quill, you do have your due process rights are not being violated here. You don't even have to have any physical presence in the state to have due process nexus. So it's very easy for a state to meet that threshold, right? All the state has to show is that you are purposefully availing yourself of a marketplace. Basically, you're trying to get customers in their state, all right? So it's very easy to defeat. That's very important that the Supreme Court said that. However, they said that Commerce Clause nexus has to have substantial nexus, not just that minimum connection. And substantial nexus means physical presence. And physical presence has to be more than some slight physical presence. And so North Dakota is saying, yeah, but we got these floppy diskettes. And the U.S. Supreme Court basically slaps them down and says, don't even, bring that. Because they said a few floppy diskettes is what we've rejected before as the slightest presence. And that's not enough to have substantial nexus under the Commerce Clause. And as far as the North Dakota Supreme Court saying that Bellis Hess should be overturned, the U.S. Supreme Court said, no, that's good law still, because there's a bright line there that says physical presence is the standard. And under the principles of stare decisis, we want to stick with that earlier decision. So for that purpose, we disagree that it's time to jettison Bellis Hess. So Bellis Hess, still good law. And it creates a safe harbor. Quill is agreeing with this concept that there is a safe harbor for vendors whose only connection in a state is that there are deliveries made to that customer by common carrier or the postal service. So now it's time for us to think about, where's the pendulum? Where would you put it? All right, I'm not going to make everybody answer a poll question. What do you think the answer is? Here's what I say. I say with Quill, and particularly when you think of kind of the evolution. because you could make the argument that Bellis Hess was an outlier. And it's really, in a lot of ways, it was, because every other decision was going against the taxpayer. And then Bellis Hess pops up there. Because if you think of Scripto, Tyler Pipe, Complete Auto Transit, every one of them was coming down and saying, basically, it's very easy to have Nexus. So you got the feeling that the Supreme Court was going to kind of continue that trend. But they came in and said, no, the slightest physical presence isn't enough. You've got to have, the bright line test says, you've got to have substantial nexus, not just some slight physical presence. So now, let's wrap up our discussion of the mattress company. Remember, they were in Oregon making deliveries of mattresses to Washington. The question is, did Washington have the right to assert nexus on them? Well, we talked about this briefly last time we met. And, some people would say, yes, there is a difference between making deliveries in your truck versus making delivery in a third party's truck. I don't know, personally, why there would be a difference. If you make 5 deliveries in your truck, why is that automatically nexus creating in some people's mind? However, making 5,000 deliveries via UPS is not nexus creating. It doesn't make sense to me. So I would at least try to argue, for my client's sake, if they're under audit, that making deliveries in your own truck is not necessarily a nexus creating activity. But if they were asking me prospectively, Andy, we want to do this and this is how we're going to do it, do we have to pay tax or collect tax in our other state? I would have to probably say, well, let me ask you what you would say. Did Washington have a right to assert that the mattress company had nexus in their state? Or should they have argued it more forcefully? Apparently they caved on it and put them out of business. And remember, we don't have any Supreme Court case that talks anything about making deliveries in your own truck. The only Supreme Court case that we have on this, well, there's 2. There's Quill and Bellis Hess, and both of them saying making deliveries in somebody else's trucks is not nexus creating. But they didn't make a big, that's not how they reasoned it out. They didn't say, making deliveries in someone else's truck, that's not enough physical presence. They just said making deliveries is not enough. Okay? Are we done, Ashley?
Yeah, not everybody has voted, but that's okay.
All right, so 61% say they have nexus, 39% say Washington was overstepping. I agree with both of you. Washington was overstepping. I really believe that. However, I think they had nexus, and here is why. I'm going to show you this case. Like I said, there's no U.S. Supreme Court case, but there is an Illinois Supreme Court case called Brown's Furniture. And look at the facts here. Like I said, it's Illinois Supreme Court. This was a Missouri furniture company, and they were delivering furniture on their own trucks to customers in Illinois. And the ruling by the Illinois Supreme Court was, note that this is 1996, so this is post-Quill. So they had to incorporate the language from Quill. And they said, Brown's Furniture has established more than a slight physical presence within the state. So let's look at their facts, though. All right. They said there's a couple of things that Brown's Furniture is doing. One is they're advertising in Illinois. And when we looked at a 10-month period, Brown's Furniture made 942 deliveries in its own trucks. So that's quite a bit. I mean, that's 3 a day for 30 days a month, I think. And they said, that activity is more than incidental, occasional, sporadic. So we think that that is more than the slightest physical presence. What did the U.S. Supreme Court say? Well, we don't know because it was appealed to the U.S. Supreme Court, but certiorari was denied, meaning the Supreme Court did not take it up. And the Supreme Court signaled, basically said in Quill, we are not taking another case. We have said that this is a Commerce Clause issue, not a Due Process Clause issue. Therefore, it's up to the Congress. If Congress doesn't act, that's up to them. We're not taking any more cases. And so Brown's Furniture was a chance. They said, no, we're not taking it. So the decision stands. It's valid, of course, in Illinois, but it's also instructive with the absence of the Supreme Court ruling on this issue. Out of caution, you would have to say to your clients, unfortunately, I think you may have Nexus because of this issue. And it would be wisdom for you to collect sales tax in this other state. So, yeah, I'd have to say I think that Washington was aggressive. And, yeah, you should try to fight it, if you're under audit. But unfortunately, I think it's true that deliveries in your own trucks for sales tax purposes, and I'm going to talk about the diversion of income tax nexus and sales tax nexus and why there's so much confusion, especially on this issue in particular. Because in some states, delivery in your own trucks is specifically not a nexus creating issue for income tax purposes. So now, let's talk about the current law of the land, and let's talk about income tax nexus versus sales tax nexus. So for the Quill addressed in many people's mind both income tax nexus and sales tax nexus, even though it was a sales tax, that was the facts of the case, okay? And Quill said states can force you to collect or pay their tax as long as you have a substantial nexus. And substantial nexus means physical presence, at least for sales tax, okay? This is where you're going to start to see the difference. There have been lots of attempts over the years at uniformity, trying to make things so they're not so complicated from state to state. You've got the MTC trying to model tax laws that states can adopt. You have the SSTP, which has been an effort by multiple states to kind of get together and simplify, or at least make their laws similar enough that they can then go to the federal government and say it's no longer such a burden to comply with the law because we have streamlined it. Trying to get the federal government to legislate. Most recently in the news is the Marketplace Fairness Act, which has been passed by the Senate, and the House has not acted on it. With the current situation as it is, hard to believe that the House is going to take this up anytime soon. And a lot of people would say it was dead on arrival at the House anyway. But this is the closest yet that we have ever, I've been doing this for 25 plus years, and pretty much every year, a lot of pundits will say, okay, this is the year we're going to simplify the sales tax, going to get Congress to pass a law about Nexus so that there are uniform standards. And that's the commentary almost every year, this year being no exception. Well, with the Marketplace Fairness Act, that's the furthest we've ever gotten, but the Marketplace Fairness Act in so many ways is really terrible for especially for small businesses. But anyway, that's the attempts at uniformity. But even with Quill, since there have been no laws passed, no regulations giving specific examples at the federal level, who has the right and power to regulate interstate commerce, the question has to be, how much presence is substantial nexus? We know that it has to be more than the slightest, so we know that 3 software diskettes or less is not enough. But what about 3,000 software diskettes? Is that enough physical presence? We don't know hardly anything. The other thing we don't know coming out of Quill is, does Quill apply just to sales taxes, or does it apply to all taxes, income taxes, grocery receipts taxes, CAT taxes, franchise taxes? Does it only, those standards that the Supreme Court talked about, do they only apply to sales taxes? This substantial presence thing has impact in so many areas. Does this is where you get the questions about, what about internet sales over the internet, and do I automatically have Nexus because of my quote unquote independent sales reps? This click through affiliates, these bloggers that link back to me. I'm in Amazon. Do those, is that enough to have substantial Nexus? New York thought it was, and New York won against Amazon. Like I mentioned last time, that's kind of started the whole cascade against Amazon. But does this physical presence standard apply to these other taxes? Many states have read the Quill decision and said, we are only going to abide by Quill to the extent that the question is on sales taxes. We're not going to abide on it for income tax purposes. And how do they get to that point? How does a state assert that Quill only applies to sales taxes? It doesn't seem like it should, but there is just a few words in that decision that give the states this idea of that there is a different standard for sales taxes than there is for income taxes. And here it is. Because in deciding not to overturn Bellis-Hess, they made a parenthetical comment, really, kind of a throwaway comment. And they said that, this bright line physical presence requirement that Bellis-Hess established in the area of sales and use taxes is still good law, okay? So that little in the area of sales and use taxes is what gives the states in their mind the opening to say, okay, Quill is for sales taxes, and but they aren't touching income tax. And so the states are saying, hey, wait a minute. All right, physical presence is a requirement for sales taxes, but we don't have to apply it to our income tax Nexus standards. We can go a whole different direction. Let me tell you about kind of the first case and the biggest one that kind of broke this open. This is a 1993 case, all right, post-Quill. This is the Toys R Us case, and Toys R Us had a structure in place, a lot of companies did back in this time period, where they had a Delaware holding company. Delaware does not impose income tax on income from intangibles. So the strategy was to place intangible assets into your Delaware holding company, and then that Delaware holding company would charge royalties to the operating companies. All right, so in a consolidated return state for income tax purposes, that would make no difference at all because those are all intercompany charges that are all washed out, right? Well, many states, especially at this time, and South Carolina being one of them, were separate return states, meaning there was no combined or consolidated reporting. So a way to drive down your income tax in South Carolina would be to place trademarks into a Delaware holding company. The Delaware holding company charges royalty expense to the South Carolina operating company. That income isn't taxable in Delaware. And then there's reduced income in South Carolina. Well, as long as you think that physical presence is required for them to tax that Delaware holding company, them being South Carolina, then you say to the Delaware holding company, do not do anything that gives you physical presence in South Carolina. So the corporate people would have to be very careful to restrict any Nexus creating activities to Delaware only. So it was a big affair that people went through. There's offices that you could have in Delaware, bank accounts, post office boxes, etc. A big deal to set up these Delaware holding companies. Well, South Carolina said, forget about physical presence. You don't have to have physical presence in our state. The fact is, you've got economic presence in our state. Well, the South Carolina Supreme Court said, yeah, you do have nexus in our state on the basis of intangible property. All right, I got to get my alarmed Jeffrey up there. So you might say, wait, how can an intangible item, which by definition has no physicality, right? How can an intangible item have physical presence anywhere, let alone in South Carolina? And South Carolina said, I don't care. It doesn't matter because we don't have to have physical presence. Quill said that only applies to sales and use tax, or at least that's our argument, South Carolina. It was appealed to the U.S. Supreme Court, but again, Supreme Court did not take it. So this was a huge case. I remember when this came down because it really threatened a whole bunch of people's Delaware holding company. Since that time, a lot of states have changed and gone away from separate return filing rules to combined or consolidated. So that strategy is not nearly as powerful as it used to be. But with South Carolina saying physical presence is not required, then it kind of shoots all kinds of holes in the whole approach anyway. Well, South Carolina's small state, so maybe it's not all that important. But here are just a few other cases with the exact same approach. You had West Virginia, where West Virginia said, no, Quill's physical presence requirement only applies to sales and use taxes. Remember, they're just going off that little parenthetical throwaway comment that I showed you. And New Jersey also agreed that physical presence does not apply to income tax nexus. Both of these cases applied to the appeal to the Supreme Court, neither of which did the Supreme Court take. Now, there is a divergence, unfortunately, for all practitioners and for companies trying to figure this out. There are different standards for nexus for income tax purposes and sales tax purposes. Now, theoretically, it should be, if there's going to be different standards, it should be harder to have nexus for income tax than sales tax, because sales tax, all you are is a collection agent. It's not money coming out of your pocket. True, it's costly to comply, but it's not money coming out of your pocket. It's coming out of your customer's pocket. Income tax, on the other hand, truly is taxation without representation. So if there are different standards for nexus for income tax versus sales tax, it just seems like it ought to be harder to have income tax nexus. But ironically, darkly, it's actually easier in most states, many states, to have nexus for income tax. That's because the states are ignoring Quill when it comes to income tax. They're saying, physical presence, that's an outdated standard, and it only applies to sales tax per Quill. And it's easier to have nexus for income tax, ironically, because of Public Law 6272. Public Law 6272 actually prohibits states from asserting income tax nexus, but only in this narrow set of circumstances. So, like I say, it's unfortunate, first of all, that there are different standards, and ironic, I guess, that it's easier in many states to have income tax nexus than it is for sales taxes. All right, Ashley, poll question.
Okay, third poll question. And for anyone who missed the second poll question, you can chat that to me, and I'll send you the question, and you can answer it for those of you who wanted CPE credit. Okay, that's just about everyone, so let me share those results.
Okay, so 2/3 of your clients are probably oblivious. That's not surprising to me because most people are thinking it's all about physical presence. So, with that evolution, with this divergence of Nexus standards for income tax versus sales tax, and states becoming very aggressive, and the Supreme Court refusing to take any more Nexus cases, and the Congress not acting, it basically leaves the door wide open to an evolution of Nexus in the wrong direction. And so this is why I say the momentum is solidly in the favor of the states. They are since the Congress isn't saying anything, and the U.S. Supreme Court isn't taking any cases, then and saying they're not going to take any more cases, then states can just kind of say everything creates nexus, and if you don't like it, then take me to court. But it's not going to go to court, so good luck. Now let's talk about what is causing so much confusion. What I think creates confusion is this whole idea that there's different nexus standards. And it comes down to solicitation. Because remember, Public Law 86-272 said if your only activities in the state is a solicitation of a sale of tangible property, then a state cannot assert income tax nexus on you. So now that's the federal law. There's no extensive body of regulations like IRS Treasury regulations, nothing like that, to really describe what is solicitation. So you have states saying, well, if it's not exactly solicit, if it's anything beyond solicitation, then you don't even have protection of Public Law 86-272. However, apparently, in passing Public Law 86-272, remember way back in 1959, Congress also contemplated in some of their discussion points in passing this law that there could be certain quote unquote ancillary activities to solicitation that would not create nexus. So what you have is this confusion that people sometimes are focused on. They've heard something about nexus and solicitation doesn't create nexus because whoever's doing the presentation is really talking about Public Law 86-272, but it didn't seem to register with the person that's listening to the presentation. So they get caught up in their mind that as long as you're just selling, you're okay. I may have an employee in the state. Sometimes people will say this to me, but all they're doing is selling. So that's not a nexus creating activity. And that's somewhat kind of paradoxically, someone will say, I have an employee in this state, but they're not selling. Therefore, I don't have nexus. I don't know how they get there, but that's what you hear sometimes. So the question though is, for income tax nexus purposes, what is solicitation and what are ancillary activities that would also be protected along with the solicitation? Well, I mentioned the Multi-State Tax Commission before as one of the bodies trying to create uniformity. Really, you've got the MTC, which has been around since 1967. Okay, does that timing with Bellis Hess make any sense to you? As of 2011, 47 states were members of it. The Multi-State Tax Commission is a state tax agency. Okay, this is not like a neutral body. Okay, sometimes they seem like that's the way they want to come across, but they are a state tax agency. It's like an intergovernmental state tax agency, and 47 states were members of it as of 2011. There's been a recent movement for states like California and others to withdraw from the multi-state tax compact because it's killing them on certain income tax cases, but that's beyond the scope of our discussion today. But there's a lot of states that are members of it, and the MTC will promulgate certain model tax laws, and most of the states will adopt them. So in 1986, okay, so this question about solicitation comes up. Now, the MTC is not known for brevity in naming their documents, okay? So they issued the Statement of Information Concerning Practices of the Multi-State Tax Commission and the signatory states under Public Law 6272. All right, and what does that statement say? Well, they came out with their list. Everyone's asking for bright line regulations. Okay, the MTC obliges. And they came out with 13 activities that would be protected, 19 activities that might be like solicitation, but they're not protected. All right. So remember now, don't get confused here. We're talking now about situations in which Public Law 6272 would apply. Nothing else are we talking about. We're not talking about sales tax. We're not talking about non-income tax. And we're not talking about companies who sell anything other than tangible property, okay? I'm just illustrating why there is such confusion when it comes to this, because sometimes people think this applies to everything. But anyway, here's the list of protected activities, 13 of these. I'll just kind of show you a few. You can do some advertising, that's protected. You can solicit orders, but not if the person soliciting the orders maintains any office or business in the state. So an office in the state would not be protected. You can carry samples around, but only if you give them away without charge. You can set up display racks. You can kind of resupply display racks for where you can set them up, as long as you're not paid for that. Your salespeople can have automobiles if all they do in those automobiles is protected activities. A salesperson is protected if they pass orders back to the home office. If they coordinate shipment, that's okay. They can maintain their own sample room if it's limited to 14 days or less at any one location, or else after that, then they're deemed to have an office. They can mediate customer complaints if the purpose of that mediation is solely to ingratiate the sales personnel with the customer. They can own, lease, or use personal property like cell phone or something, as long as they only use it for conducting those protected activities. So even when they're putting out the list of protected activities, it's severely restricted. That's what I'm saying. It's really easy to have income tax nexus, especially for states that don't recognize the physical presence standard. Well, the MTC came out with 19 unprotected activities that if you're performing these, you cannot cite Public Law 6272 as your protection. If you do repairs or maintenance, if you investigate creditworthiness, meaning your salespeople, just because you call them salespeople doesn't mean PL 86272 protects you. If they supervise installation, or they do the installation themselves, if they do some training, if they provide any kind of technical assistance, if they resolve customer complaints, if they approve or accept orders, if they repossess property, if they pick up damaged inventory that you can't sell, and they take it away, or obsolete inventory, whatever. If they maintain a showroom for more than 14 days at one location, any of the following facilities or property in the state. There's the list. it's a lot of stuff. I recognize, it's not supposed to put so much text on a slide, but I just want to show you that there's not much protection. Entering any kind of franchising or license agreement is not a protected activity. Now, granted, the MTC is not binding on all states, but this is what has created the Nexus confusion. That's why you have some people saying, oh, solicitation creates Nexus, solicitation doesn't create Nexus. This is why I'm trying to protect you from getting confused. Now, this issue of what constitutes solicitation under the Public Law 6272 has actually gone to court. Guess what year it went to court? The Supreme Court, I mean. Yes, 1992. And so in Wrigley, you had the whole issue was activities of salespeople and are they protected from income taxes in Wisconsin? What did those salespeople do? Okay, so gum is tangible personal property. There's no services. You don't buy a maintenance agreement on gum. There's no services that Wrigley was selling. Wrigley took the position that we don't have Nexus in Wisconsin because all we do is solicit orders. Well, Wisconsin said, not so. Your people do more than solicit the sale of tangible personal property because they go into the store and look at the racks, and if any gum is stale, they replace it. All right, well, you might say, oh, wait, that's de minimis. Well, the U.S. Supreme Court said, no, it's not de minimis, even though the percentage of sales or the percentage of inventory was minuscule. I don't recall it right off the top of my head, but the actual revenue that this contributed to was so minuscule. It makes you think there is no such thing as de minimis when it comes to Nexus. The U.S. Supreme Court said, that's right, replacing stale gum is not a solicitation activity. That is a Nexus creating activity, and you cannot cite the Public Law 6272. That does not protect you in this case, all right? So once again, 1992, that's an income tax case. Do you see why states feel so emboldened? Yes, Quill sent the pendulum back to the favor of taxpayers, but states are so aggressive because they can be. Wrigley is not the only case that ruled on this issue. There's been all kinds of rulings on it. I'll just point to a few. Let's see. You've got Connecticut, who said that providing sales order forms and advertising material is protected. Making delivery in your company vehicles. Okay, all right, great. I'm glad I brought this up. So here is another thing that contributes to the confusion. Okay, we all agreed, or most of us agreed, that Washington could assert Nexus. It was a B&O situation with that mattress company. However, Maryland and Nebraska both say that in rulings in their state that making deliveries in your own vehicles is a protected activity under Public Law 6272. All right, well, but Washington's B&O tax is not a net income tax, so you couldn't have used that argument in Washington. But you can see where people can get confused. Maryland and Nebraska have a net income tax, and they said making deliveries in your own vehicle is a protected activity, not Nexus creating. All right, so there's all kinds of other cases. Regular checks of customer inventories was not protected. Swapping stale product not protected. Buying or selling product not protected. Visits by credit managers not protected. In other words, Nexus creating. And Public Law 6272 didn't protect you. All right, I could go on that, and if you're really interested in those decisions, we can make those available to you. So let's just step back a minute, a little review here. The current Nexus standards, like I said, they're different for income tax and sales tax. For sales tax, okay, so let's try to really keep our minds separated here. This is where I see people get so thrown off. For sales tax, you have to have physical presence and it has to be substantial. But that substantial physical presence is such a low standard, unfortunately, because remember, they said 3 software diskettes isn't enough, but they also said 1 independent sales rep is enough, okay? So I don't want you to feel like substantial means what you might think it means, like, oh, I got to have a whole bunch of physical presence. Unfortunately, no. Now, physical presence is not a required standard for income tax in a number of states and in a growing number of states. And even where you have the protection of Public Law 6272, because it's a net income tax state and all you do is sell stuff, you better make sure that your selling activities are in that list of protected activities. All right, so it's narrowly defined. Someone mentioned in their question that let's talk about market-based nexus. I'm not exactly sure what that is, but I think it has to do with this economic presence thing. And remember, the North Dakota Supreme Court said Quill had an economic presence in North Dakota. So that should be enough. And the U.S. Supreme Court said no, at least not for sales tax, that's not enough. Well, the MTC came out in 2002, and they said economic presence should be the standard. Forget about this physical presence. At least for income tax, it should be about economic presence. And they said that if you have 500,000 in sales, that's enough. That's enough presence in a state for you to have Nexus. Ohio was one of the first states, or the first state, to adopt that economic presence standard, and they did that back in 2005. Washington has also jumped on board there. The thresholds are lower in Washington. Here's another state that you might think. I mean, Texas is a great state to be. It's no corporate no personal income tax, but they have the Texas franchise tax. Some people call it the margin tax. Well, Texas is one of the most aggressive taxing states, but somewhat, surprisingly maybe, the Texas says that you have to have physical presence. Quill applies to the franchise tax. All right, so that's kind of an outlier. But again, if you look at Texas's list of what creates Nexus, it's such a long list of very small items, very by in and of themselves, it's a very low threshold. Michigan, they keep changing their corporate tax up there, but the Michigan business tax, which has now been replaced by the corporate income tax, but still in effect for audit purposes, also had even the corporate income tax has a economic presence standard. Okay, as long as you're in the state for at least for more than one day, then it's all about economic presence after that. All right, Ashley, I'm going to take a breather, and we're going to have a poll question.
Okay. I have launched the poll question. This is question number 4.
Okay, I really hope everyone gets this right. I hope we have a 100% correct on this one.
The audio. Overall, really, really good. Not as crisp as last time.
Okay, I am sharing those results. And Andy, it looks like we are all over the place today.
Okay. All right, I was just checking with some of our staff on our audio, see how it's coming out. We're trying a little different approach. I'm using my standing desk today. All right, let's look at the results here. All right, Do the protections of 86-272, let's see, well, this is kind of a weird ask. Let me see about this question. Do the protections of PL 86-272 apply to, all right, maybe it's, hold on. Okay, yes, I'm looking at the wrong thing. The protections of Public Law 86-272 apply only to net income tax, right? That's what I've been trying to really emphasize here so that you don't get confused. There are different standards between income tax nexus and sales tax nexus, and Public Law 6272 is all about protecting against income tax nexus only, okay? So I'm glad we asked the question so we can finally clarify that so there's no further confusion. All right, so where do we stand today? Well, it continues to be a muddled situation. Now, like I said before, Congress as a body has not passed a law except for that one, PL 86272. That was passed way, way back in 1959 and has not passed anything since. The U.S. Supreme Court was very active in Nexus questions up until Quill, when they said, this is a question now and forever to be answered by Congress. And if they choose not to act, so be it. In that vacuum is where the states have found all kinds of ways to be very aggressive. There's even, as the world evolves and as digital products come into being, this is a further muddled situation. Can digital products give you Nexus? Or if you're selling digital products, are you selling tangible personal property such that you would be covered by Public Law 6272 for income tax purposes? We just don't know the answer to that. Obviously, in 1959, there was no such thing as a digital product. So, would Public Law 6272 give protections there? I would have to say yes, at least theoretically. I think that you would have to say if the federal government said that you shouldn't have to pay income tax if all you do is sell stuff in a state, then that stuff would include things like digital products. But states have just not addressed this issue for income tax purposes. They have in a number of states have addressed it for sales tax purposes because they want to collect tax on those sales. But they haven't focused on whether that's tangible property for income tax purposes. All right, so that's another area where there is it's a muddled situation, unfortunately. Now let's go back to that valve company. Remember, the company was put itself up for sale, found a buyer. The buyer came back and said, "You guys have exposure all over the place. Maybe income tax, for sure, sales tax." The question is, did they have Nexus? Let's look at it. Let's look at both income tax nexus and sales tax nexus. Well, for income tax purposes, thankfully, they happen to meet the very narrow protections afforded by PL 86272 because at the time they sold it, these valves were tangible property. So they were selling tangible property. Their only activity in these other states was the solicitation of tangible property, but those salespeople did none of they didn't maintain an office of valves. Obviously, they didn't install them themselves. They sold them to contractors who would install them. They didn't go and replace stale valves or broken valves. They just sold them to contractors. So at least, I mean, I guess you could get a very aggressive state and try to find something that those independent brokers were doing that would not be protected. But remember, we're in a negotiation with the buyer. And very confidently, we can say um, we're protected. From an income tax standpoint, I don't think we have very much exposure at all because we're protected by PL 86272. Now let's turn our focus over to sales tax. We know that under Quill, there has to be a substantial presence in a state for them to have sales tax nexus. But we also know, and Quill did not overturn Scripto or Tyler Pipe. In Tyler Pipe and Scripto, independent sales reps created nexus. So at least from the question of nexus, you'd have to unfortunately agree that they have some potential exposure because of nexus activities for sales tax. So what happened? Did the deal get killed? Was the CPA sued by their client because they didn't give them good advice? Did they have to declare insolvency and go to the bank and tell them that they're in violation of all their bank covenants? Let me just tell you what happened with this company. Fortunately for them, once we got involved and looked at their situation, we were able to identify some areas that ended up saving the deal because we were able to reduce their exposure by more than 90%. Here's how we did it. And this isn't magic or anything. It just, there are some really fortunate circumstances here. First of all, we said, all right, wait a minute. You have no income tax exposure, so let's put that aside. You're selling tangible property to a contractor who is going to then incorporate that tangible property into a federal government-owned land. So the federal government is always exempt from sales taxes. Now, a really tricky question is, and many states have gotten around this by saying, yeah, but you're not really selling to the federal government. You're selling to a non-federal government person who is then going to consume that item, and they're providing a construction service to the federal government. So the federal government isn't your customer, Mr. Valve Seller. In other states, this exemption from the federal government is allowed to flow through the contractor, okay? So in looking at their exposure by state, we noted which states have this so-called flow-through exemption from the federal government through a contractor. And then it's just a matter of getting the proper certificates in place so that we can present them to the buyer doing the due diligence and say, see, in these states, I can wipe out the exposure you've identified in these states because I now have the right certificates from these contractors. So now I've wiped out part of this liability exposure. However, there was remaining exposure in one state in particular that I remember, in Georgia. And I don't remember, it's something like $1 million. And Georgia does not offer any such flow-through exemption. So you would think, man, you're dead in the water. This is where the fortunate circumstances came into play. It so happened that Georgia, in that very time period, was a new member of the SSTP, the Streamlined Sales Tax Project. And when you join the SSTP, you have to offer full amnesty for a year. That amnesty from tax that you didn't collect. Well, that's a huge deal. And states' amnesty programs, other than the SSTP, never offer amnesty from tax you didn't collect. They just offer amnesty from penalties and interest usually. So this amnesty program, very short-lived, was exactly what they needed at exactly the right time in Georgia. Now, when you take advantage of the SSTP amnesty, you have to be very careful. There's a lot of caveats there because you could be exposed in all the other SSTP states beyond the scope of this discussion. So we had to work through carefully the voluntary disclosure process in the other states so that by taking advantage of the amnesty program in one SSTP state, we didn't automatically expose ourselves to exposure in all the other states. So, again, that's probably more information than you ever wanted to know. But in this case, it basically wiped out their potential exposure. The rest of the exposure was small. It was a large number, but spread out amongst a whole bunch of states. And so the buyer looked at it and said, all right, you have met, when we look at this, we really don't think that we have a lot of exposure. And so the deal went through. And so it was a fantastic result when it looked potentially disastrous at the beginning. So I guess the lesson of everything here is Nexus is such a low threshold to what creates Nexus for you. And income tax Nexus is even easier in most states to have than sales tax Nexus, unfortunately. So when you're advising clients, if you're under audit, if you're going through a sale, then yes, you want to be as aggressive as you can in arguing against Nexus. But when they're asking you on a prospective basis, what should we do? Then this is where you want to be pretty conservative. I mean, that's our nature, ourselves as CPAs ourselves, is to err on the side of caution. Because what we're trying to do is help people avoid that circumstance where they're shut down, like that mattress company was, by the huge assessment in Washington. And so, yes, we want to give the most helpful answer to our clients, but we want to give the answer that will keep them in business. All right. So what we tell clients a lot of times is what you want to avoid is what we call the biggest tragedy in sales tax. The biggest tragedy in sales tax is, and it applies in some respects to income tax as well. But the biggest tragedy is you have Nexus in a state. You didn't know it. And you sell taxable products in that state. And you didn't realize it. And so when you made the sale, maybe a whole bunch of sales in that state, you didn't collect the tax at the time of the transaction. And then 4, 5, 6, 7 years later, the state finds you and realizes you had Nexus. Well, tax you could have collected from your customer at the time of the sale that they would have willingly paid ends up coming out of your pocket instead. Not only that, adding insult to injury, it's penalties and interest on top of it. It could be a bunch of sales that were made at no profit or at a loss. It doesn't matter when it comes to sales tax. It's just sales tax rate times the selling price, and you owe it to me. And good luck trying to get it from your customer. Your customer may now be out of business. You may not want to go back to your customer. It's too far in the past. Your customers, it may have been a bunch of small sales, and it's not even practical to go back to your customer. So that's why I say it's such a tragedy that you could have collected tax at the time of the sale. If you would have realized how easy it is to have sales tax Nexus and how much easier it is still to have income tax Nexus, you would have kind of bit the bullet and said, man, we do have Nexus. Let us just get registered. Let's take care of this going forward. Let's look at our back tax liabilities and address them, and then let's start collecting tax going forward. Then you would have avoided that tragic circumstance. So hopefully all your clients will get this great advice. Now, I'm at the point here where I want to wrap up. And of course, if you have any specific questions about Nexus creating activities, those we can address. We have the other charts and lists of activities that we made available. We do have extensive resources on a state-by-state level of what activities create Nexus, but they're so state specific. Once you get past those 10 Nexus creating activities, then it comes down to such a state-specific approach. Because like I say, we just have those court cases that we've spent a lot of time going over as our only guidelines. you come up with some specific question, then you've got to look at state law, state cases, and see what they say. So we can do that for you if you have those specific questions. A lot of times, in my experience, in talking to clients, um, really you can answer most of their Nexus situation with the 10 common Nexus creating activity list. Because if they're conducting those, then pretty much in every state that they're conducting those activities, they have Nexus for sales tax. So that's usually the approach that we usually use. If there's some other activity that they're conducting, let's say it's just attending a trade show in some state, and they want to know, does that create Nexus? A lot of times I'll first of all inquire about the materiality of, let's say it does create Nexus, what does that mean? I mean, what sales are you making in that state, and what do you sell in that state? Well, we don't really make a lot of sales in that state. We're just wondering. Well, if you're making a lot of sales, then you may want to err on the side of caution there. If you're not making hardly any sales, then I would say don't worry so much about it. So a lot of times that's where the Nexus discussion ends up. Now, like I say, if you have any more specific questions, by all means, let us know. We'll try to get back to you and answer those. But now I would like to end this presentation by saying thank you to all of you. We've been together for 2.5, almost 3 hours, and I appreciate your patience in listening to us. Hopefully this has been useful to you, and hopefully we can work together in the future. So with that, I say back to you, Ashley.
Thank you, Andy. And that list that Andy mentioned is available on our website, PeisnerJohnson.com, for those of you who didn't download that yesterday. Also, a couple of the questions we had, Tuesday. A couple of the questions that we got on Tuesday, I think one of our other webinars would be a great resource for you. So check those out on our website. In closing, I would like to kind of share with everyone some of the ways that we work with other tax professionals. That includes state sales tax return filing. We also offer a 16-point refund review to see if you or your client is over or underpaying sales tax. We talked about getting audited by the state. We can definitely assist in those situations. We have talked a lot about Nexus, so obviously we can help you determine if you or your clients have Nexus, and we can help you work out a plan to mitigate any exposure there. We've got 3 programs to help you there: a brief consultation or a Nexus analysis, and of course a really in-depth Nexus study for you. We also provide a variety of compliance-related services like business registrations, exemption, certificate management, tax engines, tax rates, and so forth. So we always say that if we can answer a question off the top of our head, we are happy to do so at no charge. So that's always another way that we can be a resource to you. Before we wrap up today, I'm going to post a link to your CPE certificate. I have it pasted here, just doesn't want to go. There we go. So follow that link to download your CPE certificate. I will also post a link to the slides. And again, you will receive a follow-up email in 1 hour that will contain both of these links. So for whatever reason you don't grab your certificate, or you want a copy of the slides and you don't get that, you'll have that link coming at you in your email box in about an hour. So with that, I thank you so much for your time and your participation. We are going to wrap things up now. If you would like to chat us any questions before you log off, we'll stay around for a few more minutes. If not, as soon as you close the GoToWebinar control panel, that survey will pop up automatically. And that's for those of you who would like the CPE credit, or anyone who would like to share any feedback with us. We do really value that and take that seriously. So thanks a bunch, and we will see you in another webinar soon. Bye-bye.